Well, greetings and salutations. This is the Series 7 Guru, Dean Tenney, coming to you from my studio in fabulous Las Vegas. If you haven't joined us for the Tuesday live streams, at the end of that, we do a drawing for a free coaching call. And, basically, it's the same as tutoring, but it's free. And I want to distinguish between, what is paid content on the channel and what is free content on the channel. Sometimes people like to go over, certain subject areas. Sometimes we like to do practice questions. Devin and I have talked here just before I hit the record button. Probably the best use of the coaching call is to do some practice questions, poke around in his brain housing group and see what's going on. He's one of those conundrums in terms of people who do what we ask. They do their practice tests, they're getting good scores, and for whatever reason, still sometimes struggle with some questions. So we'll find out how we do here. And we got to give a shout out to Kaplan. Kaplan allows me to give you a free look on Kaplan content. If you don't have a Kaplan Q Bank, it's a good paid supplement with my 10% discount code at checkout. Good with 10, it's $58.50. All right, now that we got all the preliminaries out of the way, let's get going. If an investor were to purchase a bond in the secondary market several years after the public offering, which of the following would factor into calculating the total dollar amount paid for the bond? And I'll let you answer the question, and then we'll see, like how we did, and then I'll comment on that. I call this explication. That just is a fancy word for more than an explanation, a little bit of commentary as we go along the way.
It would be 2 and 3, wouldn't it?
Well, the day-to-day is when it starts to accrue interest for the next time frame. And that would have something to do with the accrued interest. But here it's the settlement date, because we're going to calculate up to, but not including the settlement date, and the total price paid for the bond. So here, indeed, it would be the settlement date and the dated date. So indeed, 1 and 2. I think we've got a typo with Kaplan, because that's not one of our choices. So I think we're going to have to go with 1 and 3. Accrued interest, there we go. Settlement date for the first interest payment. And then the coupon. I don't like the coupon, so I'm disagreeing with this one. I'll take it up with our Kaplan subject matter expert. A customer is short 100 shares of XYZ at 26 and long an XYZ 30 call at 1. First thing I think is smart guy. You can memorize a lot of option stuff. But, I think if you understand options, what I mean by that is you're not fumbling around that's a choice to buy the stock at 30. And you can track money, then you're in pretty good shape. And so what is the maximum potential loss? What say you, my friend, in terms of the maximum potential loss?
Would that be B, 500?
Yeah, excellent, right? I really think this is a great kind of a question to make sure you understand, because if we didn't have this, we'd have unlimited loss potential. And man, if you had a choice to buy back the borrowed stock, you put in a ceiling here now at 30. I think of options is all about floors and ceilings, right? So now we have this position hedged. This is an effective hedge. I would definitely know that the point of adding the long call to the short stock position is you no longer have unlimited loss. By the way, a lot of different ways to do options, Devin. I'm not sure if you I brought in 26. I paid out a point for the protection. I'm net out 25, net in 25, excuse me. I pay out 30, however you did it. That's correct. So as long as you're getting right answers, we don't want to overthink it. So excellent. And then the other thing I would know is that you wouldn't be effectively hedged if you put in a short put, because you don't want an obligation to buy, you want a choice, right? If this was a short put, it would be C, because it wouldn't be effectively hedged. And then the other thing I would know is that you could mitigate. Another way to mitigate this risk would be with a buy stop order, right? So if I can't get you to buy the call, I say, hey, Devin, let's at least put a buy stop at 28 or something. 28.
All right.
An investor is short the stock at 60. The current market price of the stock is 33. Wow, bueno. We're looking good. Investor anticipates it will continue to decline, or even better. We're trying to sell high and buy low, so everything's going according to plan. And the investor would like to generate income. I hate these questions with a passion. This is just so stupid. But once they say generate income, it means it's either A or C, right? Because we have to sell the option, but still benefit if the stock continues to fall. Which of the following positions would do this? What say you?
I'd say A.
You are correct once again. Now, it sounds like your options are pretty squared away. I like that. Oh, how do we miss that? Sell a 35 call.
Selling a call is
Yeah, that's
the
stupid. That's what
opposite.
I think. Generate income for the benefit of the stock decline. Oh, well, I disagree with this. I would have missed it as well as you did. What Bill's the guy who's in charge of this is saying if it goes down further, we're going to get exercised on the put, which is true. Okay, got us. Me, I would have missed that just as much as you did. An investor buys one DWQ 70 call at 5, giving them the right to buy 100 shares at 70. Now, I'm always suspicious of this. I mean, they shouldn't have to tell us that when we buy a call, we have a right to buy 100 shares of the stock at 70. But hey, thank you so much. I'd be worried if we didn't know that that's what that meant. Which aspect of the transaction is not standardized? OCC is the issuer and guarantor of options, and they are standardized, which makes it easier for people to play. And so here they're asking us what part of this is not part of what we call the option description.
Which would be a premium of 5.
Excellent. Right. That's set supply and demand. Has two components, the intrinsic value plus the time value. Excellent. I would definitely know the OCC is the issuer and guarantor of all options. I would know they're the ones who publish that OCC disclosure document. How does the OCC assign exercise notices? Test question. So if somebody exercises this call contract, because it's American style, and they can exercise anytime. So I call my broker. I say, I want to exercise my DWQ April 70 call at 5. And then my broker dealer calls the OCC. And then how does the OCC decide which broker dealer is going to have to deliver 100 shares of a DWQ at 70 to yours truly? How does the OCC do that?
Through FIFO or by random selection, correct?
I got you. OCC does it randomly. The OCC
Okay.
does it randomly, right? So they call Merrill. Merrill says, why, yes. And there's, well, you must have missed this on your Series 7. It was randomly. Now, within Merrill's client base, they probably have more than one customer who's short the DWQ April 70 call. So now the question is, how does Merrill decide of its customers who are short that series? Series is the most complete description of an option. DWQ April 70 call. Which one of their clients has to come up with the stock? And you were correct previously. Random, FIFO, or another fair method. I can't think of one. Right? What they can't be, test question, is they can't be discriminatory. They can't say, oh man, there's that jerk, let's get him. No. And they can't say, oh, I mean, that's Devin, I don't want to do it to him. They can't be discriminatory. Whatever they're doing, they have to tell the OCC and their clients. And if they change it, they got to notify everybody by it. Most of us do it randomly because it's a lot less paperwork than trying to track things. So most of us do it randomly. A municipal issuer's flow of funds statement is contained in
The legal opinions. I'm going to take a shot and say the notice of sale.
I got you. It's actually the trust indenture, aka the bond contract. Right?
Okay.
That's where we find the flow of funds. I like this answer set, by the way. Like this answer set. Very much like the test. All of these could have been right answers to different questions. The answer here is the bond contract or bond covenants or the trust indenture, however we want to describe that. And then we would always assume on the test a net revenue pledge. So that we would assume on the test a net revenue pledge found in the trust indenture. And under net revenue pledge test question, which fund has priority? Where's the money going to flow to first? And that would be the operations and maintenance fund. Very testable. Now, the legal opinion is very testable as well. The legal opinion is done by a bond counsel. I would know who does it. It's a bond counsel. And then the legal opinion will either be qualified or unqualified. And what would be preferable? Qualified or unqualified?
Unqualified.
Yeah, unqualified is good. That means without reservations. Sometimes I'm talking to my attorney. He says, Dean, you have my unqualified legal opinion. I'm willing to litigate a year and a half to a successful conclusion. There's no doubt what the law says here. And then every once in a while, I'll be talking to me. He says, well, Dean, I'm willing to litigate till you run out of money. I have to qualify this. I'm not quite sure how this will play out. That's not what I want to hear, right? I want to hear unqualified. Now, they're going to opine about three things. They have the legislative authority to borrow the money. The issuer has the legislative authority to borrow the money. Number two, that the bonds are federally tax exempt. And number three, that they're exempt from the Prospectus Act called 33. And so munis are exempt from 33. I would know that. But more often than not, since 1933, when I've sold people brand new securities, they go, can you send me something? They've grown accustomed to getting something. And so if I'm trying to sell you a new municipal bond, you might say, can you send me something? And the prospectus-like document for munis is called an official statement. An official statement, right? So, that third thing, they're federally tax exempt. They're exempt from the Prospectus Act. So we don't use prospectuses when selling muni bonds. We use official statements. Notice of sale, very testable. So notice of sale would indicate that this is going to be a competitive underwriting. So the issuer says, attention, investment bankers, we're looking for some help. And I say, hey, Devin, did you get the bond buyer today? Test question. The bond buyer is a must subscribe if you're a municipal finance professional. I said, you get the bond buyer? I said, yeah. I said, you see the notice of sale for that city's GO bonds they're going to do? He said, I did. I said, would you like to join my syndicate? And you say, well, Dean, I'm forming my own syndicate. I said, well, say it ain't so. Various syndicates based on the notice of sale, the bond buyer test question, newspaper widely read in the municipal market. And then we'll all form our bids. I say, hey, Devin, no hard feelings, my friend. If I win the underwriting, my syndicate wins by providing the lowest net interest cost to the issuer. Would you like myself or one of my syndicate members to call you and invite you to join, not as a syndicate member, because that ship has sailed, but as a selling group member? And you say, yeah, Dean, I still have some people who want some muni bonds, so great. And then you say, hey, Dean, if my firm wins, my syndicate wins, do you still want to help sell bonds as a non-syndicate member? I said, yeah, I'd love to be in the selling group. Selling group members are never liable for unsold securities. Now, before I maybe I say, you want to join my syndicate? You might want to say, well, Dean, what kind of syndicate is it? Is it divided? Is it undivided? Is it Eastern? Is it Western? Before you decide you're going to take down some bonds. I said, Evan, it's $100 million underwriting. It's a divided Western syndicate. How much does your firm want to take down? You say, Dean, my firm wants to take down 20 million. And a divided syndicate, what goes down stays down. So, you tell me you're going to do 20 million, you're doing 20 million. Now, in an undivided syndicate, it wouldn't be 20, it would be 20% of the deal. Now, we are going to have agreement amongst ourselves as underwriters about who's doing what, right? So the agreement amongst the underwriter, that is the agreement we have amongst ourselves about how we're going to run the syndicate. And then you should definitely know the components of that. I have a whole video on underwriting munis. So all those answers are testable. Which of the following strategies is considered most risky in a strong bull market? Now, I don't want to put pressure on you, but if I were in charge and you missed this question, I would flunk you immediately on the entire exam. I would just have your seat shoot you into the ceiling and say, hey, you don't know that writing naked calls are not smart? I think of writing naked calls as picking up nickels in front of bulldozers. I mean, that's not smart, man. If you're right, the stock goes down. You agree to be a potential victim. Nobody victimizes you. The calls expire. You go neener, neener, neener. But if you're wrong, boy, very testable to know what subjects an investor to unlimited risk. So if I come into your broker dealer and say, I want to lose so much money that you in advance can't tell me how much. As well, there's very few things that will do that. Naked means you don't have the stock, right? Naked put, cash equal to the aggregate exercise price. So that's definable. Shorting the stock is another one, right? A customer has purchased 100 shares of Synovile lubrication products at 95. The date of the purchase was April 22nd. 3 months later, the customer purchased one SLP December 90 put at 3. At the expiration date of the option, SLP's market price is 101, and the option expires unexercised. The customer sells 100 shares on June 1st of 2022 at 104. The sale results in, this one's a tough one.
Yeah, sorry, Dean, I got some issues on my end.
Oh,
With
no
my
worries.
dog
No
bark.
worries. Oh, that's okay. So let's just talk about this. Here's the point. A lot of people say to qualify for a long-term capital gain, you got to hold an investment for more than 12 months. And I never say that. What I say is to qualify for a long-term capital gain, you got to be at risk for more than 12 months at risk. And the minute we purchase this put for 90, we're no longer at risk, right? Because we did some construction, we established the choice to sell, we bought some insurance. And so what happens here is we ended up interrupting the holding period. The holding period is no longer when we bought that stock on April 22nd, 2021. The holding period now resets once I'm no longer at risk. So 3 months later, that's going to reset that. Now, if I just bought the put out of the gate with the stock, it wouldn't matter. And if I had bought the stock and had it a year and then I bought the put, it wouldn't matter. And I think test prep vendors like Kaplan go a little overboard on this, but it is what it is, right? So the expiration date, so now I go back, and the expiration date was December, the third Saturday in December at 11:59 p.m. Eastern time. And I had April 22nd. So it looks like it's a short-term gain on the stock of 600, and then the puts expired, it's another 300. So it looks like it's a short-term gain of 900, right? Just going through that again, right? Because we interrupt our holding there. Let me get on my annotation tool. Once we did this, boom, we were no longer risking the stock position because now we have the choice to sell that stock. So that's something to kind of be aware of. I think, like I say, I think the test prep vendors go total overkill on this. I think we should know that why do we do this? To protect the stock position. So we made 95 to 101. That's our 6. And then the put expired and the put was 3. So that's where I'm getting that $900. All right. Next one. Tough one. One of the advantages of writing a call option covered by the shares of the underlying stock is, I like this, covered calls. You're going to get 5, 6 covered call questions on the test. I like this one. Why do you do it? We're talking about suitability, and we were hoping to get some suitability kind of questions in our coaching call here.
This would be B.
Yeah,
Immediate income generators.
Right on. This is very much a test question. You do it to generate additional income. I mean, I mean, I was a baby broker decades ago. This was one of my go-to moves. I'd call you up, say, hey, Devin, how would you like to agree to sell high stock you would just buy low? Somebody will pay you $100 in advance today to agree to sell stock high you just buy low. In fact, there's three sources of profit. One is the premium that we're going to get right now. Second source of profit is the difference between what we paid for the stock and the strike price, and any dividends along the way. That's our third source of profit. And we do get some price decline protection. To be honest with you, this is like level one approval at most firms. Somebody wants to generate additional income on stocks they own. The ROP is going to say, hey, not a problem. Knock yourself out. One of your clients is neutral to bearish. Yeah, I could tell you're having issues on your in there. When we say neutral, that means that if there's no volatility, we're going to win. So way kind of north of the test is itself, but in a long call, I'm buying upward volatility. You know, when I buy a call, I'm saying, I think the stock is going up. I think at least X number of points up, and I am timing. I got to be around three things. In a short call, I'm selling the volatility. I'm saying, well, okay, I think you're going to be wrong. When I buy a put, I'm buying downward volatility. And when I sell a put, I'm selling the volatility. So neutral means I'm selling an option, right? So usually, right? So that means I can make money if it doesn't move. The person who buys the option has to have the stock move. Anyways, it says, and would like to sell calls on it to generate some income. Now, way north of a coaching call and way north of, the test, I think. But we basically have three types of covered calls. We have bearish covered calls where we agree to sell the stock in the money. We sell in the money call contracts. We have neutral covered calls where we agree to sell at the market price, strike price, market price. And we have bullish. Wishing to minimize risk, I think that's going to be a hint that we want some good premium income. You would suggest the client cover the call and take other steps to protect against unlimited loss. This could be done in all the following ways except. All right, so another tough one. This one's pretty tough.
Reading the question a second time here.
Yeah, of course. RTFQ, RTFA. A lot going on in this question. A lot.
Or take other sources of protection. Okay, so they're looking for protection against unlimited loss, but they want income.
Yeah.
So,
by the way, test taking. Yeah, go ahead. I'm sorry. Go ahead.
No, you're fine. It's an accept question as well. That's what I was going to say.
Right. And what I was going to say about the accept, this is just a test taking trick. This is just Dean. I'm just commenting on the answer set as a test taker. As a test taker, I like to look at the answer set, and just from C and D, I think it's one of those because they look different. Right. So
It can't be both.
Right? Yeah. I'm kind of thinking, maybe it could, but I'm on the trail of thinking, I'm kind of sniffing this thing out. And I'm thinking, okay, if I think it's C or D, that is a test taker. What I'm going to do is I'm just going to confirm whether I'm going to take A and B, because then it helps me be more sure of that. So choice A says that we can minimize the risk by depositing 100 shares of the stock in the account. Well, absolutely, right? Because that makes it a covered call. I mean, if you're selling calls, but you have the stock, that works, right? And B, you have a convertible bond that you can convert in the stock if you get exercised, that works. So it is indeed either C or D. And then your point, you always got to remind yourself on the accept questions, right? I can't tell you how many times I miss an accept. Like, oh, damn, how did I do
that? So to protect against unlimited loss, let's say it's a short call, it's going up. I would say C.
Yeah, C, simultaneous purchasing a put. You got it. Good job. That was a tough one. By the way, the other ways you can tell them tough is when you read the rationale, it's like, it fills up the screen. That's like, that's a hint that it was not just your plain vanilla kind of a question. On Monday, June 1st, an investor pays $92 to purchase a 5% J&J municipal bond maturing July 1st, 2030. Purchaser bonds paid accrued interest to seller. Well, thank you so much. Sometimes the test gives you free information I would have expected you to know that already, but you know, every once in a while the test just gives you some free information. You go, okay, well, thanks. How many days of accrued interest would there be? How many days of accrued interest would there be?
So since it's a muni bond, we're using actual versus,
No, no, no,
oh,
no.
we're using 30-day
Yeah,
versus
corporate
actual.
immunities,
Yeah.
right? Corporate immunities.
And the settlement date would be June 3rd, correct? It
Well, let's
takes 2
see. It
days.
says on Monday, June 1st. That's correct. They didn't tell you. Now be careful because they didn't say settlement, your point. So what I would like to do, what I like to do on my, when I'm doing like this is my official Promector scratch, just make a note of June 3rd now as settlement. And you are correct, right? T+2. So trade date is Monday, June 1st. So T+1 is June 2nd. T+2 would be Wednesday, June 3rd. It's not necessary to know that's a Wednesday because it's a business day, but that June 3rd is going to be important.
And then it's maturing on July 1st. So I would put 1/1.
Are you going to use my shortcut? Oh, I'm so happy. I'm so happy. Some people don't use the shortcut. If you're going to use the shortcut, what you're going to do
Yeah.
is you're going to take 6-3. I'm going to show you both ways here for people on the replay, but
Right.
that just warms my heart that you're going to take the settlement. This is called the shortcut. For those watching the replay, this is the shortcut. And Devin was correct. He said, Dean, if I'm going to use the shortcut, as I recall, I subtract the last time the bonds paid interest, which was January 1st. And he is correct. That is exactly how you'd go about using the shortcut. And I just think, ladies and gentlemen, this is just so much of an easier way to do it. And I can't help you or Devin with this arithmetic. 1 from 3 is 2. And
So
1,
the answer would be A,
that's correct.
152.
That's right. And I just think that that's much easier, by the way, than, you know, doing the count. Now, if you want to do it the old fashioned way, this is the math that would be necessary to do that. All right. And then you'd have to know that on, and let's put that in a different color or just a little bit smaller here. And then you'd have to know when you got paid on January 1st, it was for up to, but not including that. Every month has 30 days, March, 30 days, April, 30 days. I just think that's, you know, much more of a mess. And then up to, but not including. If you're using the shortcut, you include, but if not, remember that makes sense because that's when ownership changes hands. So indeed, correct. You are correct.
Which, if it was a treasury bond, it could get a little hectic that way.
Well,
right?
remember treasuries, I put that in the category of governments are goofy. And they're goofy in that they settle T+1. They're goofy and that they trade in 30 seconds. And they're goofy in your point because they use an actual calendar. Indeed. By the way, for those of you watching the replay, no, the shortcut doesn't work on government securities. But I doubt you're going to get a government securities except for recognition on that. Non-statistical factors used in comparing one mutual fund to another would include all of the following except. I think this one's kind of stupid.
Would it be D?
Yeah, I think they're going to want management fees, but I think it's kind of stupid. Let's see. Non-state usually include all the following except. Yeah, I think that's pretty stupid. I don't know. Let's see if I got it right.
Oh, it's A. Okay.
Yeah, that's pretty stupid. Pretty stupid. By the way, you know, that's the reason I always say too, we got to overlearn this stuff. Because, you know, even on the real test, you get stupid questions and you're not really able to raise your hand and go, hey, look at this stupid question. You know, you got to kind of just go with the flow, right? A producer of fine French wines has signed a contract to export 10 million of wine to a distributor in the United States. Now, I kind of like this one, and we got to be a little careful here. Anyways, using listed foreign currency options, this producer would have the best protection against currency risk if
So I remember Epic when it comes to a question like
Okay,
this.
so I think that's right. So remember, so Epic is for exporters buy puts,
Right.
importers buy calls. So this one's a little tricky because it's a French exporter. And so to use Epic, I'm going to turn it around and I'm going to say, okay, well, I'm a US importer of French wine, right? Epic will
Right,
now,
because we're dealing with dollars.
that's right. And then remember, the dollar is not a foreign currency. Now, the other thing you could do is there is the opposite from the perspective of Epic. And the opposite, remember, when it gives you the perspective from a foreign offshore kind of perspective, would be IPEC, right? This is a French exporter. French exporter.
So
So you could,
instead of the exporter buying puts, the exporter would buy calls.
yeah. And then remember what and then you again, if you're economically sound like Dean is, I try not to memorize too much stuff, but I think, what would I be afraid of? If I'm exporting wine to the US, I'm worried about a weak dollar because it doesn't get me as many euros. And if I say the dollar is going down, remember the dollar is not a foreign currency, not being facetious. If I'm saying the dollar is going down, that means I'm saying the euro is going up. So a couple
Right.
ways to get to this right answer. You could use Epic. If you're going to use Epic, you got to say, okay, that's the US perspective. So if they're exporting wine, there's a French importer, right? Somebody who's importing the French wine into the US, right? So you either can take the foreign perspective or the perspective of the company. By the way, you should have been able immediately to get rid of this and that, right? Because you should know the dollar is not a what? Foreign currency, right? You can't do things on the dollar. And by the way, I'm patriotic to buy puts on the dollar. Now, back in the day, I would be, teaching internationally or doing international business. And I would say, you can't buy puts on the dollars because it's not patriotic. And the guys in London would say, oh yeah, watch this. From their perspective, they could, but not from a US perspective, right? So we're going to buy those euro calls. There are no listed on the US dollar. I think that's important to remember that. So that reduces your choice to long euro put or call. Because the contract will be paid in dollars, the producer, the French wine guy, is concerned the dollar will fall. Or state another way, the concern is the euro will rise, and there we go. Okay. Remember this IPEC, so there's that other one. So Epic, US looking out, IPEC, exporters looking into the US, right? So that's the opposite. What all the following could be advantages of buying an option contract except.
Wouldn't be A, wouldn't be B, wouldn't be D. Would I go with C on this one?
I would go see, yeah, because remember, I used to make my brokers write 1,000 times. Options are wasting asset. Time value erodes. So I'll just give you an example, Devin. If you buy an Apple 195 call at 6 and your break even is 201, and let's say it's December. And December, the call expires, but in January, Apple goes to 200. And I said, well, Devin, you were right about two of the three things. You were right that Apple went up and you were right about how far, but you messed up on the timing. And that's what makes it harder to run an option, right? Because in a stock, all you got to be right about is one thing, direction, and you have forever to be right, but not in an option. So my brokers, I'd make baby brokers write 1,000 times. Option are wasting asset, time value erodes. At expiration, the option's only worth its intrinsic value. If the option has intrinsic value, the contract will be exercised. If the option contract has no intrinsic value, the option will expire. And for the person who bought it, that's going to be the worst news. You lose your premium, right? 999 more times. Options are wasting asset. Time value erodes. At expiration, an option only worth its intrinsic value. If the contract has intrinsic value, it will be exercised. If it has no intrinsic value, it'll expire worthless. Now, I try not to be too much of a stickler, but I'm under no obligation on the test to tell you whether an option contract got exercised at expiration or whether it expired. And every once in a while, somebody will send me a question where they're struggling And they're struggling because they're not able to figure out that it says at expiration, the stock is. And then you're supposed to be, oh, okay, at expiration, the stock is okay. So if it has intrinsic value, then that means it got exercised. Okay, let me put that into my T. Or if it has no, then that's a fat zero, right? And that could be good news or bad news. So to purchase an option, speculate, fully participate. There we go.
So when the option is exercised, yeah, that's when you would put it into your T.
That's
Other
right.
than that,
That's right. That's right.
Okay.
That's right. An investor would sell a put. An investor would sell a put.
Let's see here. Wouldn't be A.
Yeah, it's not A. It's not A. By the way, remember our test taking trick. C and D are opposites.
Oh, so it would be C, right?
Yeah, it has to. Yeah, well, yeah, it has to be one of those two because they say exact opposite things, right? You can't leave this answer. You can't leave C and D in the same universe together, right? So that means you can't pick A or B because then you're telling me the guy is bullish bear. That one doesn't work unless it's like a straddle or something. So that's one of those tricks that we talk about. I think I call that the principle of mutual exclusion. That C and D are mutually exclusive. So almost always it means it's one of them is the answer. The one I use, if you watch my test taking tips, tricks, and memory aids, is Socrates is a dog. Socrates is a philosopher. Well, he can't be both. He's either a philosopher or he's a dog. He can't be, so. A customer writes 1 ABC, 60 put it. The put is exercised. The customer's cost base in the stock is.
The cost basis in the stock. Yeah. So it would be B60. It's a put. Let's say because 350 in.
Yeah.
So would it be C? 5650?
Yeah. For the most part, if you're watching the replay, for the most part means there's exceptions, but almost always, if you just translate cost basis to break even, almost always on the test, you'd be correct. Because for the most part, cost basis follows break even for the most part, right? So, for example, if I say you buy an Apple 195, call it 6, and you exercise, what's your break even? And you would say 195 plus 6, my cost basis in Apple's 201, right? So, if you want to translate cost basis to break even, 99 out of 100 times you'd be right. Now, the exception to that is in a covered call. In a covered call, the break even does not follow the cost basis. But other than that, it's pretty much the break even is the cost basis. An investor reading the annual report of an investment company notices that among the company's expenses was the payment of interest on outstanding bonds. Ooh, this is a tough one. The company also paid dividends on preferred stock. Now, I'm not sure I would have tested you this way, but this is a tough one. You only get 1 point, but if I were in charge, you'd get 2 points to get this right.
Would it be B, a balanced open-end mutual fund?
No. By the way, this one's tough.
Oh, yeah, it was those two.
No, that's okay. Let's talk about what they're testing on. I think this is a tough way to do it. But you did get tormented on your exam about the difference between open-end funds and closed-end funds. And open-end funds are only allowed to issue one class of equity. All they can have is common stock. But a closed-end fund could issue preferred stock. Be careful. I didn't say an open-end fund can't own preferred stock. I didn't say an open-end fund can't own bonds. I said they can't issue them. And so that means they all they have is common stock. Now, closed-end fund could issue preferred stock, take the proceeds, make additional investments. They can issue bonds, take the proceeds, make additional investments. So the hint was here where it says payment of interest on the bonds. And so that means it can't be open end because they're not allowed to issue bonds. And then it says it paid dividends on preferred stock, and open end funds aren't allowed to issue preferred stock. So this is actually asking about the restrictions of an open end company versus a closed end. So I think what I just said is testable, but I'm not sure you would see it this way, right? So the closed end that is allowed to have bonds and preferred stock in its capitalization. Open end funds, mutual funds, and ETFs can only have one class common. Don't confuse the contents of the portfolio with what they can issue. I like that one. That one's tricky. Sometimes the way I say it is Kaplan jerks are bigger jerks than the real jerks, right? So, trying to stretch your mind to Kaplan, hope it doesn't go back to the same spot. All right, which of the following is not a characteristic of a closed-end fund? Now, remember, we started this by picking 3 heavily tested areas of the Series 7, which were options, muni bonds, and mutual funds. So that's what we're doing here in terms of what we're up to.
I would say C, because they can't redeem shares.
Very testable, right? They trade supply and demand. So if I'm a closed-end fund manager, neat thing for me, I never have to worry about meeting redemption requests. If I'm a closed-end fund manager and you call me and you're unhappy with me, I say, hey, sell your shares to someone else, my friend. You're not going to send me a redemption request, right? So that means I can stay fully invested, by the way, at all times. Index option contracts that are commonly referred to as the fear gauge, I like this, are based on the expected or implied volatility the S&P 500 are known as.
And the answer would be C, the VIX.
Yeah, that's definitely a test question. Definitely a test question. Remember, it's the fear gauge. So if you think the stock market's going down, you buy VIX calls, because you think people will be more fearful. So it has that inverse relationship in terms of the market itself. There you go. Which of the following is not an advantage of buying listed call options as compared to buying the underlying stock?
Let's see. So we're looking for not an advantage. So that wouldn't be C or D.
Yeah, I like it. I love it. That's a great way to think as a test taker. So you got a 50-50, always helpful.
Right. And then buying call allows greater leverage than buying an underlying stock. I would say the answer is B.
It is. Remember, the time value thing is not an advantage, it's disadvantage, right? That you got to be right, and you got to be right within the time frame, right? You have to remember, if you buy a call, you got to be right about 3 things: direction, how far, and timing, or you're going to be a loser. Which of the following statements describes the conduit theory of taxation?
I would say it's 1 and 3 here.
You are correct. And how much is the minimum to distribute? Oh, they tell you 90%. What else is 90 besides mutual funds? What else is 90 besides mutual funds? Very testable. REITs
are also
real estate
90.
investment trust. Yeah. So remember, I'm asking to pull things out of the stratosphere, and on the real test, they wouldn't do that. Ladies and gentlemen, if you're watching the replay and you too would like a free coaching call, it's usually 30 minutes, but if we decide to do practice questions, I think the minimum to be, viable and have something to talk about is 20. And in that case, we run a little over, not a problem. If you want to join us, the drawing is Tuesday night at the end of our live streams, which is about a little before 6 Las Vegas time. The live stream starts at 5. Remember, inch by inch, your exam is a cinch, yard by yard, your exam is hard, and I'll see you Tuesday night, I hope. And boom.